welcome back to Bullish, everyone. I am Sam Hardy. You know Nick Stenger. We are Stenger Family Office. For the past 42 years, it has been our mission to deliver both clarity and confidence to help secure your financial future. We have a great episode lined up, a great guest. We are very excited. He is a leader in our industry. And before I turn it over to Nick to introduce him, just need to mention a few things. Remember, anything discussed is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For full disclosure, visit StengerFamilyOffice.com. We've got two big events coming up. There are Spring Wealth Insights Forum, April 17th at Gibson's in Oak Brook. We're going to be hosting our Chicagoland folks. We're going to be joined by another great guest there doing a live podcast, so don't miss that. April 24th, we're going to be down in Houston at the Trulux in the Woodlands and going to have a lot of our crew down there. So would love to see you. And with that, episode 13, Nicholas, take it away.
All right. Thank you, Sam. Welcome, Matt Cole, to the show. For those of you who don't know, Matt Cole is the Chief Executive Officer, CIO, Chief Investment Officer as well of Strive Asset Management. Matt oversees Strive's investment philosophy, strategic positions, and product lineup. He's head portfolio manager for Strive's equity ETFs. He's actively managing the fixed income ETFs as well. Prior to Strive, Matt was a PM for CalPERS out in California, where he oversaw more than 70 billion with a B, in actively managed fixed income portfolios. While at CalPERS, his portfolios were among the best performing portfolios in the industry. It did not underperform their benchmark in any single year. Very tough to do. Matt Cole, welcome to the show.
What's up, guys? How's it going?
Oh, we're doing good. How are you?
Doing great. Happy to be here.
So, Matt, tell us a little bit about yourself. Tell us about your background. I just read your bio here, but give us some color and tell us a little bit about Strive.
Absolutely. So I've been in the industry going on 20 years. It's starting to make me feel a little bit old, actually, but I was at CalPERS for 16 years, and I joined there because my parents were in the law enforcement industry. They had their pensions tied to CalPERS. My grandpa had his pension tied to CalPERS, and I think we're probably of similar age, and graduated right in the midst of the great financial crisis and was debating going to New York, joining a Wall Street firm, but decided to stay home in Sacramento, California, and work for the largest pension in America, trying to fix a retirement crisis that our country faced and still faces to this day, where the average public pension is under 80% funded. And so for CalPERS, that was the pension for my parents. So I wanted to fix it. So like you said, I worked there for 16 years. I rose up to be portfolio manager, their youngest portfolio manager, and had a great track record of outperformance for 11 years. Ended up managing over $70 billion of their $500 billion pension. Sounds great. What was interesting about it, though, is that while I was there, I added $1 billion of alpha to the fund, but the fund was $200 billion underfunded. And so I really started realizing I was picking up pennies in front of a steamroller of this problem that I desperately wanted to fix. And so it really got me focused on what is the more macro problem, and can I actually help fix this problem outside of CalPERS, not just for the pension fund of California, but for all investors. And that's what led me down this route to Strive. And if I was to define Strive, I would define it in a couple of different ways. Shareholders first, pro-capitalism, and pro-meritocracy. And those three fundamental principles, I believe, are missing in this industry today. And it's at the expense of investors that they're missing. And so Strive is on a mission to fix this.
So company was started by Vivek Ramaswamy, correct? And you guys, as I understand, are pretty good friends. Tell us what it's like having a friend run for president.
It's pretty wild, actually. So, I've gotten to know Vivek really closely over the last couple of years. We've become really close friends. We talk every day, and he just has the biggest of ambitions. And it's a pretty wild thing when your friend calls you up and says, "Hey, I think I'm going to run for president of the United States," and is not joking. And I remember the conversation in early 2023, when he first talked to me about it and said, "What do you think?" I said, "I think you should do it." And the reason was, it wasn't clear if it would be good, bad, or indifferent for Strive, But when you have someone that's been so successful in their life, he's a billionaire, doesn't need to work another day in his life. Well, what's his life mission? To have the most positive impact that he possibly can on this country. And it became clear that Strive was going to succeed with or without him, and that he could actually try to impact this country as well. And I do think that Strive is a for-profit capitalist organization trying to change corporate America, get corporate America back to its fiduciary roots, these shareholders first, pro-capitalism, pro-meritocracy. I think those are some of the founding principles that make up American capitalism, that's produced more technological innovation that helps humans flourish around the globe, and also better returns to investors. So Strive was doing great. He had the opportunity to help impact America. And I think, it was pretty amazing to me to see him rise from 0% support to 8% support. That is a massive achievement in and of itself. I think he's going to be a force to come for years in the political arena. I think right now he's actually impacting legislation. I think he's actually impacting the talking points of not just Donald Trump, but also the Democrats. I think he is putting pressure on people. And I think there was an article, this is more related to Strive, but it was talking about the CEOs of America are tired and they're afraid of being yelled at by Vivek Ramaswamy. And I think that that's true. And I think that's part of how we're able to have success is we're shining a light on bad fiduciary actions that are happening across this country. He's doing it in the government level. And I think when you do that, you actually achieve success and actually achieve meaningful change.
Man, I think it's super important what you're talking about. And obviously, some people like Vivek, they don't like him, whatever. It doesn't matter. But I think what's really important for people to understand is Strive was actually founded by Democrats and Republicans, right? Obviously, you have Vivek on the Republican side, but tell us a little bit about the backstory on Strive and the founding and some of the funding and where that came from.
Yeah. And so we'll quickly talk on some of the people, but I actually want to talk on the substance of why this is not a political movement, but a pro-fiduciary movement. So yeah, Vivek founded the company. We also have Bill Ackman as an investor that is a left-leaning individual. We have, myself, I would call myself more on like the Christian libertarian conservative side. Our head of research is a liberal. And so I think we have a good mix of people from different political ideologies. And I think that comes to a core concept, diversity of thought. And that's what we have here. And so what we're talking about with Strive, there's this whole debate in the industry, ESG, anti-ESG, and we've been labeled an anti-ESG firm. And for the first year and a half of our founding, I said, no, I'm not anti-ESG, not anti-ESG. I believe every single risk factor should be considered in investment decisions. We have views on E, we have views on S. Our main differentiator is G, governance. We are not anti-ESG. And then the media, the investment industry says, no, you're anti-ESG, you're anti-ESG. After all this debate, I've come to a conclusion that ESG is not actually looking at environmental risk, social risk, and governance risk from a first principles basis. It actually only allows for a certain subset of beliefs in them, and of them are not just supporting American capitalism, putting the shareholders first. And so I actually have come to accept that we probably are anti-ESG, but we're not anti-considering any risk factor in investment decisions, because that's what any good investor should do. And that is not a political statement. It's a, what is the purpose of a corporation statement? And I think that's what's missing in our industry today.
So, Matt, let's talk a little bit about what the real issue is, because I think before Strive came onto the scene, there were a couple activist ETF shops out there that we know of, like Engine One. We could touch on that in a little bit, but let's go back to the beginning. What are some of the issues that have come up for clients who aren't aware of this? They've got money in defined contribution plans at their 401k. They've got money in defined benefit, like where you were with CalPERS. What's the control of those funds look like from a fiduciary standpoint? We've got BlackRock, we've got Vanguard, we've got State Street running a lot of that, but give people a little background on why this issue is so important.
This issue is important because probably every single person listening to this podcast, most Americans have exposure to the stock market. And when you have exposure to the stock market, you are an owner of most publicly traded corporations, likely through index funds today. Over the last several decades, there's been the rise of the index fund, which is a passive fund where you own most companies in the stock market. You have a vote and you have a say as an owner of the future direction of that corporation. And so historically, prior to the rise of the index fund, you did not have concentrated ownership of most corporations in America. But today, most companies, the ownership position of the large asset managers is over 20%. And so they make up the largest shareholder of almost every single company in the S&P 500, not just the S&P 500, almost every single publicly traded company in America, which is a really interesting problem. We're not even talking about how they've used the votes yet, but just it's an interesting problem to have the same owner as the largest owner of every single publicly traded company. That creates the possibilities for corruption to exist in a system when you have a single owner of every single publicly traded company. And that's, of course, what you started to see, because absolute power corrupts absolutely. And so why is this happening? Because there's pressures. There's pressures from the largest investors, like a CalPERS, where I came from. They are a $500 billion block of money. They are massive. New York pension fund systems are massive. The federal government plays a major influence because they see the power that these handful of corporations have. And so they've pushed the corporations to use the power of the vote, the power of corporate governance, to move these companies away from just maximizing value. And we can get into several different details, examples of what's happening there, but that's the problem in a nutshell. One block of owners of every single company in America.
Yeah. So you've got all these proxies that have to be voted, right? When you own securities, and in an index fund, people put their money in their 401k every paycheck or every month or whatever it is. They let that money sit there for 30 years. They assume, okay, I'm in a 401k. There's got to be some fiduciary protection there. There's got to be some sense of, if I'm going to give my money to the BlackRock index fund, hopefully they're watching out for me, right? And we found in recent history, and Strive's found this out, that might not necessarily be the case. What's the issue with the fiduciary standard, and where are the issues that you see specifically? Maybe give some examples of some of the votes recently, and what are you seeing as the fiduciary issue with the voting process on securities?
So let's first talk about the law, and then we'll talk about a couple examples. And so this has been a hotly contested political issue. The issue being, can an asset manager as a fiduciary vote shares on behalf of a client in a non-pecuniary, which means a non-financial manner? So looking at things that don't have an impact or potentially a negative impact on the financial returns of a corporation. And so there was a Department of Labor rule that was put in place under the Trump administration that said it is illegal to consider non-financial factors when managing money on behalf of a client. That would violate fiduciary duty. In the Biden administration, and this is where it starts to get political, but it's really about fiduciary duty. That was the second thing that was rescinded when Biden became president. The first thing was the Keystone Pipeline. The very second thing was that asset managers could consider non-financial factors when pushing corporations on behalf of clients. And so right now, it is the law that an asset manager legally can push ESG or DEI, things that might cost you money or might not help make you money, or it's unclear, with your money without your consent. That is legal today. Unfortunately, I don't think it should be legal. I think that there should be a fiduciary duty to maximize value for your client, period. But that is where we are as far as the legal landscape today. Might be different in a few years from now or a decade from now. Examples of asset managers voting in ways that, in my belief, constrain shareholder value. One of the big ones that has happened over the last couple of years is several examples of asset managers voting to constrain energy companies beyond the law of the United States. And so a couple examples of this would be Chevron, Exxon, where there was ballot proposals to make them reduce their Scope 3 emissions beyond U.S. regulations, which for Exxon and Chevron, what that means is to drill less, to frack less, to produce less energy, because you're being mandated to have less products to sell from your largest shareholders. Of course, Chevron, of course, Exxon said, this doesn't make sense. We recommend shareholders vote against this proposal. But the largest asset managers all teamed together and they voted for it and it passed. And so that's one of, in my view, one of the clearest examples. There's I think things that I would say are still clear, like forcing costly racial equity audits on corporations to spend millions of dollars to understand on a deep level every single component of race across every single part of their organization. I don't see how that actually adds value to a firm. And then more recently, actually this last week, the SEC actually approved mandated environmental climate disclosures. And so this is interesting. You might say, well, what does this have to do with the large asset managers, Matt? This is the SEC mandating large asset managers to spend, by the way, billions of dollars. Just as one example, PwC is spending $12 billion over the next 5 years to get ready to help corporations comply with these new climate risk disclosures. That's one consultant. This is going to cost billions and billions of dollars to your clients' pockets. This climate risk disclosures. We say SEC government overreach, like this has nothing to do with asset managers. Wrong. Why? Because almost every single large asset manager is on the record sending a public letter to the SEC over the last couple of years, asking them to implement this. And in several examples, actually asking them to implement it in a broader version than the SEC actually implemented. So the SEC approves it, they make it mandatory, and they say, we are doing this to protect investors. You say, well, how does this protect investors? I don't know. I can't even understand it. But when the largest asset managers on behalf of their clients request it, I think it's fair for the SEC to say it's protecting investors because the quote unquote investors, because they're obviously not the actual owners, you are, your clients are, asked for it. And I think that gets into the examples of the problems we see today.
Matt, tell the story about the open letter to Chevron that Strive wrote and then what happened after that letter was received.
Yeah, absolutely. So our first, so one of the things, just to back up a second, about governance. So we believe governance is not just proxy voting. And I think that that's the initial take is, oh, you have a proxy vote, that's it. No, most change actually happens through the process of engagements, public engagements or private engagements, meeting with the company, management, asset manager management, the owners saying, hey, these are things that we think you can improve. You meet with the investor relations team. Sometimes you meet with the C-suite, depending on the organization. And that is where most change happens with corporations, whether it's Strive or whether it's BlackRock or CalPERS, it doesn't really matter. Engagements are a critical component of a real governance process. They cost money and they actually have major impact. So we sent our first engagement letter to Chevron. It was about Scope 3 emissions. We had a really positive conversation with the CEO, Mike Wirth. And then our second engagement, I think where things got really interesting, because Exxon was actually our second engagement. And this was one of the bigger wins that we've had to date as a company. So we engaged with Exxon second after Chevron, and it was a similar type of topic. And what had happened at Exxon, though, was slightly different. In 3 years ago, 2021, 3 climate activists were put on the board of Exxon. They were put up for a vote by a climate activist, ESG, very small shareholder in the company. Exxon tried to shut it down, was not able to shut it down. The large asset managers around the world supported it, and against Exxon's recommendation, put 3 climate activists that had no oil and gas experience on the board of the largest energy company in America. Crazy. How is this in the benefit of shareholders? I can't understand it. The only way it's in the benefit of shareholders is if you think that what's in the benefit of shareholders is to shut Exxon down. But anyways, so we engage with Exxon. We send them a letter that we don't think this makes sense. We don't think that those activists are adding value to Exxon. We think they're detracting value. We don't have the shares to remove them, but another way that you can actually mitigate the power of a couple of board members that maybe aren't acting in their best interest is add additional board members that actually would act on the best interest. So we send a letter to Exxon and say, hey, we're going to run a contest. We're going to put some people up to go on your board. November of 2022, when we did that. And then in December, Exxon actually proactively, right after our engagement, just put 2 new board members on the board without even having a vote. That met every single requirement that we were looking for of a successful board member. And so they just completely took the power out from under the cells of the climate activists. And I think Exxon has been at the forefront, in my view, of not only the fight by having to reduce their emissions beyond government regulations, having climate activists added on their board, but then fighting back, putting new board members on their board, and then most recently even suing to get a climate proposal off their ballot that had nothing to do with making money. So I do view Exxon, there's a few different companies that I think have in different ways been leaders of pushing for the shareholders first movement. Exxon is right up at the top of a company that I think is trying to do the right thing.
So Matt, I think one of the pieces of pushback that we hear consistently too is, look, we all want a greener world, right? Or at least a less dirty world. None of us want to walk outside and have it be like we're, smoking 3 packs of cigarettes like in China, probably, right? So I think there's that's understood. The problem though, and I don't think a lot of people understand this, especially in Washington, is you still have all this energy demand, right? You still have all these third world countries that need energy. You have all these places on earth that are desperate to have an industrial revolution, and it's all going to be built on the back of fossil fuels. There's not enough coal or wind and solar to go around. So what really to you is the hidden agenda? Obviously we want to have a cleaner environment, obviously, but what's the hidden agenda? Because it almost seems like a lot of the point of these proposals and the point of the Paris Climate Accord and the point of the UN summit and all the rest of it is just to shut down American oil and gas and give it to the Chinese. Am I right in that? Is that what you see as well?
I think it's definitely partially that, and let's unpack that a little bit, because I think it's a very important point. But I think it's broader than just moving away from U.S. oil. If you abandon a profitable project in an oil field, project likely does not just go away. And I think that's something that climate activists need to deal with head on. And this is where we actually have a lot of people that are climate activists that actually agree with Strive on, call it 90% of what we're talking about here. Because our view is that corporations, for-profit corporations, should maximize value within the law. That is their fiduciary duty. That is not a statement on what the law should be. We believe every citizen should have one vote, one voice in a democracy to choose the laws that that this country will abide by. And I think that's a really important point, because let's say as a climate activist, you say, okay, we're going to force Exxon, we're going to force Chevron to drill less oil. Well, we have on record examples of projects that Chevron dropped that were picked up by PetroChina. So I think that's what you're talking about, where you're literally exporting profitable project from America to a competitor to our country. By the way, a competitor to our country that doesn't abide by the same climate standards, they will actually pollute more to drill the same oil than an American company would, because of the laws that we would have to abide by in this country. So you actually end up with more pollution. But it's not only that. There's also examples, which I think are also worth pointing out, is that most clients in America, or most investors, they only have access to public market opportunities because they're not an accredited investor. They don't have access to private market opportunities. Well, there is a very healthy private market right now for U.S. energy, and you make a ton of money on it. Why? Because you pick up the projects that Exxon and Chevron throw away because they have to. And so we're literally exploring offering one of these to our clients. And I actually wish that we didn't have to offer those to people. I mean, it's great. We're shareholders first trying to make money, but really these should be profits that are going to public market investors, everyday investors, not to the richest people in the world. It doesn't make the richest people in the world evil. It means that they are meeting supply-demand dynamics. They see an opportunity to make money within the law, and they help with human flourishing. Because to your point, it's not actually clear that just shutting off fossil fuels would actually help human flourishing. I would argue it's actually the opposite. It would hurt human flourishing. I think that the climate matters. I would love to see a greener world. But the reality is that we as Americans consume so much energy. I'm thankful that we do. Most people in the world don't have that luxury. They would benefit from having reliable sources of energy like fossil fuels. And so we really need to think about this holistically and not just support a degrowth agenda, don't have kids, the best days were behind us, we have to have less going forward. I think that there's actually a more optimistic version of the world that through innovation we'll actually be able to solve these problems, create a greener world, create a more sustainable world, and make money doing it. But if we want to actually make a greener world through less emissions, you have to do it at the top. You have to change the law. If you just constrain a handful of corporations, you actually end up with the worst version of everything.
Matt, let's quickly touch on Starbucks and Disney. You guys wrote letters to them as well. Can you quickly go through the stories and tell us some of the key points on those two as well?
Yeah. With Starbucks, the main point of our engagement with them was about China risk. And I think this is interesting because there's been a big push in the industry for climate disclosure, spending billions of dollars to figure out your carbon footprint, all these different things. Well, before we go into Starbucks, it's important to note that most corporations don't actually have the data to know that, which is why we talked about the billions and billions of dollars that all these consultants are going to charge for corporations to be able to comply by that. Well, you want to know what corporations actually know today? They already know it. What is their exposure to China? What is their supply chain exposure? What's their customer exposure? They have that data. Literally would probably cost some money to put together, but it's not like you have to hire consultants to figure it out. It's your business, you know it. And so there's been a lot of proposals over the last year to have corporations disclose their exposure to China, their supply chain exposure, their customer exposure. And those have been labeled for some reason anti-ESG. I don't understand. I don't, but because they were put forth likely by a right-leaning nonprofit institution, they're quote unquote anti-ESG right-leaning exposures to make corporations talk about their exposure to China. I think that's bizarre and actually has more to do with the interests that our businesses have with China and not trying to disclose them than it does with actual anti-ESG or even pro-ESG. Anyways, Strive has supported many of those proposals. We view that China risk is really underappreciated in the market. There's several different reasons why, geopolitical reasons, that if we're thinking about long-run value, which as investors, most investors, we care about long-run value, not short-run value, that it's not to say that corporations need to 100% abandon China, but they need to be aware. They need to be thinking about it. And so with Starbucks specifically, they're opening up a new store in China on average every couple minutes. And we view that to be a massive risk. You probably remember what happened in Russia when Russia invaded Ukraine, and several corporations just instantly had to shut the doors of every single corporation that they had in Russia. Well, right now, in our view, it's looking most likely that China will annex Taiwan by 2027. If that were to happen, what happens to all American corporations' interests in China? They could be shut down, wiped to zero. They at least need to be thinking about that, talking about that with investors and letting investors make informed decisions about the risks of these corporations. That was our key to our engagement with Starbucks, is we think that they are one of the corporations in America right now that is investing most heavily and most aggressively into expansion in China. And we think that's a risk that's underappreciated in the market today.
And something similar happened with Disney, correct? With the ownership of Disney China, right?
Yeah, so Disney is actually a minority owner of Disney China. The CCP is actually the majority owner. And so there's all sorts of conflicts, issues that creates. It creates brand risk for Disney, that they're going to have to do things that might be at odds with a large percentage of their customer base. They could actually just lose their ownership interest in Disney China altogether. Those risks need to be properly disclosed. Disney is not actually openly even talking about the fact that they're a minority owner of Disney China. And so we believe that investors should openly know that and be able to make informed decisions based off of that information.
Yeah, nothing like a communist roller coaster, huh?
Yeah, exactly. And I think, obviously as Americans have strong views against communism, but as an investor, it's also important to think about the risks of a communist nation on your portfolio, because they do not respect investor rights like we have in America. And I think that creates pricing risk that we need to be aware of. There's all sorts of things that we talk about with China risk, American corporations with China risk, actually the uninvestable nature, in our view, of Chinese securities to most American citizens. This is a place that we think is completely underappreciated. We actually launched a emerging markets ex-China fund literally January of last year. And I think that's interesting because of how contrarian it actually was at the time to launch a product that did not have China exposure. When the consensus trade was China's about to reopen from COVID for the first time, Chinese stocks are about to rip. That like we kind of doubt that. And even if it does, we think there's structural risks with China. We're launching this product. We think investors need to be aware of it. It's performed great. I think it's outperformed regular emerging markets by over 10%. And I think that the industry was so focused on E-risk that they ignored C-risk, China risk.
Yeah, other than the obvious, like throwing billionaires in prison, for example, in China, what are the other reasons why China is such a mess? I mean, is it just because it's a communist country, or what are where do you think it really ends up long term? Does it become the next Soviet Union and end up in a collapse, or what do you see there?
Yeah. So this could be a whole podcast in and of itself, but we could talk about the investor risks of the securities that you're investing in when you invest in a China security where you're actually not even taking a true ownership position. But I think the maybe the more macro case of just China struggling in general, to me, comes down to actually demographics and kids. And you look at their country, and their country is actually declining in population. And I think when you look forward at how are you going to solve for that? I think it's a massive problem that China faces, why they're there actually does have roots in the communist nature of China, where they were not allowing people to just have kids, right? You had a one child policy in China, and I think that is actually creating massive problems for their future growth. I do believe at this point that it's very likely that they are going to have a long cycle of struggling as a country. They'll probably still become larger than us when it comes to GDP. I think that's most likely, but I'm very bullish on America and our growth trajectory. I think because of our population differences, I think that's going to create some structural tailwinds for us, and hopefully that will continue into the future.
Matt, last question on China. I mean, how do you think? I mean, how is it possible that you've got all these people in Hollywood or these so-called human rights people in the US that are pro ESG, but then at the same time can completely ignore the human rights violations in China? I mean, it just seems so ridiculous when you actually talk about it. But how is that possible? I mean, what's really going on underneath the surface there?
Money is what's going on, in my belief. You have businesses that do business in China. You have celebrities, athletes that make a lot of money from China. And this gets to I think it's the not so hidden secret anymore, but when you do business in China, you lose your ability to speak openly about the actual true issues that are happening in this country. And it's why since day one, we've said we will never have a business line in China, period, because we will not constrain our ability to speak openly and freely about the risks that we see. And I think that it's missing on so many different levels. Last year, just as an example, we did a search of BlackRock's website. They had climate risk over 10,000 times. China risk was there one time. Why is that? It's because they do business in China. They're not alone. It's easy to signal them out, but the reality is that it's most American corporations today. And so I think it's not hard to see what the truth is when you start looking about these human rights violations that everyone knows about. But I think it becomes very interesting when you ask someone, what do you think about the human rights violations in China? What do you think about what's going on with the Uyghurs? What do you think about these different things? And you have people that will just give you a blank stare, and you know that they know, they wish they could say, but they can't say because they've created a situation where they can't speak freely and openly. And I think that's what happens in communist nations. And when you do business with communist nations, you run that risk yourself.
Yeah, next thing you know, you end up naked on TV like John Cena. So,
Oh my goodness.
Matt, let's transition here to, we really wanted to talk about this. I think it was your op-ed in The Hill, DEI killed the CHIPS Act. Let's talk a little bit about that. And for everybody who hasn't read it, it's a fantastic read. It came out on March 7th in The Hill. You can get the article online, but Matt, give us a little summary here of what you wrote.
Yeah. So I wrote this with Strive's head of research. His name's Chris Nicholson, and brilliant guy. When we talked about, the liberal wing of Strive, he's one of them, and great friend of mine, and really brilliant writer. He's also written about all the issues with the research that supports DEI causing outperformance in corporations. But this piece was about the CHIPS Act. And so the CHIPS Act was looking at risks that America faced by a potential chip shortage, so semiconductor shortage, if China were to annex Taiwan. And so let's get in front of that. Let's actually move semiconductor production back to the US. And so for people that aren't super familiar with chips, chips have been called the new oil. They are extremely important for everything that you do in life. Obviously, your phones, but even your refrigerators. Pretty much almost everything you use today relies on chips. And so it's very critical that we are able to secure our supply of chips. Otherwise, we will not have human flourishing in America for very much longer. And so they created a massive bill to give money to chips producers to move production back into the United States. And so you had all these fabs, which are where chips are produced, that were going to be set up in Columbus, Ohio, which is where Strive's actually based. It was going to be a massive Intel fab, Arizona, and other places around the country. And then you started to see delays of them actually creating these fabs, opening these fabs. And what became apparent was that these bills were so loaded with pork, so DEI pork, up and down, that they had to meet certain requirements of race and gender that they couldn't even do. They also had environmental regulations attached to them that these companies had to do. So what you're seeing is that these chips manufacturers are delaying their United States production, and then they're opening up and expanding across the globe. And so literally you have Intel expanding their fab in Israel, which, by the way, is 26 miles from the Gaza Strip. Think about risk right now when you have a country that's in a war to expand there. You'd rather do that than have to deal with the DEI agenda in the United States. That is telling you something pretty drastically, actually. And so I think this is a massive problem, and it's impossible for these corporations to comply with. And so they're just outsourcing to other countries, which creates critical risk to us as a nation to actually fix this problem. And frankly, it's a very potentially short-term problem, because if China annexes Taiwan by 2027, we could be dealing with a scenario where we don't have the chips we need to thrive as a country. And we could have had it if it weren't for DEI regulations.
So, Matt, I think one of the things with DEI that can ruffle some feathers, so to speak, is the fact that, look, at the end of the day, diversity, equity, inclusion, we're not against diversity. I don't think anyone's really against that, right? Obviously, there's some people, but most of us in the mainstream like having different voices, different schools of thought. We like some diversity, right? And we like to be inclusive. We don't want to be mean to people, right? So I think we all agree on those two letters, but the issue is mostly in the E, isn't it? It's the equity piece. And maybe you could talk a little bit about that and why why the E is actually in the middle of D, E, and I.
Yeah, and many people have actually flipped it and called it DIE now. I've seen a lot of that, but yes. So my belief is that this country was founded on an ideal of having equality of opportunity. And equity is actually not about that. And that's core to why this is so important, because the equity agenda is actually about equality of outcome. Quality of outcome is actually communism. And so I think we have to actually talk about this for what it is. And so, yes, I love diversity. I think America is such a diverse nation at this point that if you actually employ a meritocratic hiring, firing, promoting process, the chances are your workforce is going to be diverse by both gender and race standards. Very high likelihood. Now, of course, there's going to be outliers in any country that would have a meritocratic hiring process, and you might end up with whatever. But the point is that that's because you're not hiring based on having people look a certain way. You're hiring the best candidates that you can find for your company, period. And I think that that is just so basic, so fundamental to having a properly functioning corporation. Now, diversity of opinion, diversity of thought, diversity of skill set. Obviously, all those different diverse perspectives matter. I am really good at math and I am okay at reading. I'm very, one side of the brain. We need people that have the other side of the brain at this corporation. Otherwise, this corporation is going to not thrive in the biggest manner, right? You do need to bring people to create a team, right? If you have a basketball team, you want a point guard, a shooting guard, a couple forwards, and a center. You don't want 5 centers, right? You want diversity there, but you don't care about the diversity of the melon, and you care about the diversity of perspectives, of talents that create a team that can excel in whatever you're trying to excel in.
Yeah, it seems like it's almost a total focus on the unimportant qualities like race, like gender, like all these different qualities that, like Martin Luther King Jr. said that we should not look at. He said that he wanted to live in a world where none of that mattered. And I think that's what we all agree with. We all want to be in a place where it doesn't matter the color of our skin. It doesn't matter our background. It matters what we believe. And do we really love America? I mean, do we believe in the founding principles of our country? I mean, we're a nation of immigrants. We come from all different places. That's what makes this place great, And so the fact that we, are now focusing on all these qualities that really have nothing to do with what makes America a great place to be. I think it's sad, and I think you're right. I think it does come down to the tyranny of all these proposals. It seems to me like really what this is it's trying to consolidate power at the top, whether it's DE&I, whether it's ESG, whether it's climate. A lot of these proposals, when you add them up and get down to it, it's all about consolidating power.
It is in several different ways. One way is that it really makes it extremely difficult for small businesses to compete with major organizations. When you have to comply with all this different pork, all this different red tape that these larger corporations spend billions of dollars complying with, it creates an uncompetitive environment for small businesses. It creates an uncompetitive environment for this country as a whole. You see it obviously with the DEI article and the CHIPS Act. You're seeing it right now with different parts of our country, different companies that are really struggling. And then you see at the core of it, that they had implemented a very aggressive DEI policy, moved away from hiring based on the best practices is to hire the best people, and corporations are gonna suffer from that. And you have other countries that are just focused on excelling, creating, and I think that creates I would call DEI a national security risk for our country. And you're right that it's all about providing the ideal of equality of opportunity. That's the founding ideal. And so I think it's, in my view, easy to reject just because we've fallen short of that ideal historically. Might fall short of that ideal today. Those things can be true. That doesn't change the driving principle that we're striving to achieve, both for success of our country, but also for success as corporations, obviously, which is what we're focused on as a fiduciary for our clients.
Yeah, no, that's excellent. And I think Strive is on the front lines of what's so important is taking back the boardroom. I think that's how you get back to neutrality. And it's so important for people to understand that what you guys are doing is not about being Republican. It's not about being Democrat. It's about how do we get neutrality back to the boardroom, and how do you get politics out of corporate America from being decided through proxy voting? Why are we deciding government policy in corporate America when we should be doing it at the voting booth? Isn't that right?
Absolutely. corporations should be focused on maximizing value for investors. And when they do that, they're going to drive technological innovation. They're going to drive excellent outcomes for employees, for consumers, because if they don't, they will fail as a corporation. When you try to legislate through corporate America, you get the worst of everything. And ultimately, it takes the power away from you, the citizen, whether your views are you want to save the environment, whether your views are you want to implement whatever religious views you have, whatever those views are, those views should be voted on by you. And you should have the power to impact those through your vote in the political process, not from 4 or 5 different asset managers on behalf of every citizen. And so it does not matter your view, left, right, whatever. I think at times corporate America has swung one way politically, now they're swinging another way, but it's about fiduciary duty, maximizing value to investors, and making sure that whether you're an asset manager like Strive is, whether you're a wealth manager, that you're actually looking at the best interests of your clients. And the last thing I'll say on this is that there is no neutral view here today. You have to, as a wealth advisor, as an asset manager, vote on every single proposals. And these proposals are very political at times. So you have to decide, are you going to vote in a pro-shareholder manner? Or are you going to implement a political agenda? Every single asset manager, every single wealth advisor has to make a choice. And who you do business with is ultimately the choice that people are making.
Yeah, which obviously is the reason that we've, chosen to partner with you in the manner. And obviously we've talked to Justin a number of times and love the transparency that you guys provide, especially when we look at it across kind of the board, and how some of these bigger corporations in a way really try and hide what they're doing because they don't want it to be easy for us to see what it is. And your guys' great research has kind of opened the door on that front. And the last thing we want to do here, Matt, and I know you're running short on time. We always do an L of the week, which honestly, I was kind of thinking about it as I put this together. Was this may be a W for you guys, but trying to find it here. No, it's not on there. I'm looking for it's on Google Chrome. It's not letting me.
Well, here, pull up let's describe it then.
All right, yeah, we'll just describe it for you. It's the flows into ESG funds have just completely and entirely plummeted over the last kind of year here. And so again, an L of the week for ESG folks, where the number one reason that they're investing, they really probably haven't had great returns, is because what they're focusing on is not the things that provide return.
Absolutely. And this gets back to a simple principle. If you implement a constraint on a portfolio, you are going to restrict the returns of that portfolio for the same amount of risk. And that's become extremely clear in ESG funds. It would be very clear in any fund that's implementing a values-based approach to investing. And so I'm glad to see that investors are waking up, because a few years ago, that's not how they were sold. They were sold as, you can save the world and you can make more money. And people are saying, no. If you start doing that direction, it's going to cost you a lot of money. And people are like, I don't want that. I'm out. So big L.
Yeah. Matt, what's next for Strive? Where are you guys headed? Just in closing, what do you think's on the horizon the rest of this year and next year?
We're going to continue to make sure that we offer the beta products that clients need to have a full portfolio view. So right now we have 11 ETFs. We're looking at doing a mid-cap ETF. We're looking at doing an international developed ETF. And the broader vision of Strive is not just asset management. It's making sure that we can provide pro-fiduciary, time-tested principles in every single manner in this industry for people, because I think it's just there's so many things that are needed to actually fix this problem. It's not just ETFs. I think ETFs are the start of building a major financial services brand.
Yeah, fantastic. Well, thank you so much, Matt, for being with us. Ladies and gentlemen, thank you for being on this podcast. If you are sick and tired of the politicization of corporate America, you want to get things back to neutral, you want to get politics out of the boardroom, go check out Strive. They're on the cutting edge of proxy voting, corporate engagement, getting normalcy back to American life. We love them. They're great. We're using them in our portfolios. Check them out. Strive Asset Management, Matt Cole, CIO, CEO of Strive Asset Management. Thank you so much for being with us. Thank you for being on this podcast. We'll see you next time for another episode of Bullish.